Hello, everyone. It is now 8 p.m. sharp, according to my computer, here in New Jersey time, East Coast time. Welcome. Thank you for joining. This is the first ever edition of Taxes and Retirement Live. Let's see how it goes. Excuse me in advance if there's any clunkiness or issues along the way. This is frankly my first time ever attempting to do a Facebook Live. The technology here is relatively limited. I can only either share my camera and my camera only, or if I wanted to share my screen, then I can pull up some slides, and I'd have to use Zoom as a end around way to show my face on video, and I thought that may be too clunky. So for now, I'm going to show you some good old-fashioned paper I will hold up in front of the camera when the time comes. I'll be discussing Social Security benefits, specifically tax matters around those. Now, the purpose of this, the Facebook Live, is to try to do it in a slightly more or slightly less formal way, hopefully a little more fun and off the cuff. For those of you that have watched my YouTube video called Are Social Security Benefits Taxable?, I'll be going over most of the same things. Those videos on my Retirement Planning Demystified YouTube channel, in case you haven't noticed, are highly scripted. They get relatively technical. I tried to do those just free form, and I found myself rambling and saying cut every 5 seconds. So that wasn't going to work. So I had to script them. I tried to make it as sort of loose and natural as possible, but still they're pretty dry and direct. But for technical matters, I feel like they kind of gets the point across. So I wanted to try to soften things up a little bit and do a little, hopefully have a little more fun with it, and definitely make it interactive. So I see some of you have already posted comments. Thank you. Welcome. Luis, I love your excitement. Thank you. I will be responding to these comments and questions as they come up, so feel free to just throw them up there as you have them. I don't have a particular format in mind for how this is going to go. I do intend on doing these regularly, whether that's weekly or every 2 weeks, I'm not sure. We'll kind of see how this goes and play it by ear. I appreciate anyone's feedback after the fact, what you liked, what you didn't. Not just recommended topics for what to do in future sessions, but sort of format, structure, whatever. I can't see any of you, so for those of you that are concerned about that, don't worry. All I can see is what comments you post. So feel free to nod off if you want. I won't be offended, but I will try to make this as interesting as Social Security taxation can be, for what it's worth. So we'll see how it goes. Brief intro about me. So obviously everyone watching this right now follows or is a member of the Taxes and Retirement group. So I'm Andy Panko, obviously. I am a living, breathing retirement planner / investment manager. I own Tenon Financial, which is my own retirement planning investment management company. I also own a separate business that just does tax return preparation. That's called Tenon Tax Preparation. And I'm also an adjunct finance professor at Rutgers University. So retirement, taxes, teaching, that's what I do. I figured why not put all these things together into one neatly packaged group that addresses all of those, taxes and retirement, and try to approach it from a sort of educational, informational point of view. I don't want to make it salesy. I don't want to just, drop facts and figures at you. I want it to be as open and engaging as possible, ideally for people to post their comments or questions, and then I'll sort of lead the discussion and I'm very happy for everyone else to jump in as well. And then, as you notice, I'll throw in my own content and comments and topics every now and again, just to sort of spur some discussion within the group. So this live is kind of an extension of that, just trying to really boost engagement and try to make the topic of taxes and retirement as somewhat enjoyable and understandable as possible. So with that, I will get started with this. Again, I don't have a particular structure in mind. We're just going to sort of walk through some comments, show you some brief slides. Feel free to jump in anytime with questions or comments. So Social Security benefits, let's start with how they're taxed. I'll start with the state level. That's the easiest. 38 states don't tax Social Security at all. It's just simply excluded from your income altogether, as if you never got it, basically. The 12 states that do, now this is going to be a little hokey again, I apologize, I don't really have a screen share application here. These are the 12 states that tax it. Now, if you live in one of these states, it doesn't mean you will definitely have to pay tax on it. It just means that these states have regulate they have rules that address how Social Security may be taxed, as opposed to the 38 other states that it's completely cut out. So in a lot of these states, whether or not your Social Security is taxed depends on how much other taxable income you have. So some of it may be taxed, all of it may be taxed, and anywhere in between. So if you do live in one of these 12 states, don't be concerned that you're going to get smashed with additional tax. It could be nothing, or it could be a few percent or whatever the maximum percentage is for your particular state. I'm not an expert on all 50 states. Tax rules. I live in New Jersey. I know that well. I do a lot of New York returns. I've done a handful of other states, so I'm at least loosely familiar with them. But every state, which makes tax returns really interesting. Federal is pretty straightforward, but you have 50 different additional jurisdictions that all have their own rules and regulations around tax. So it gets complex, and states can all diverge quite drastically from how things are done at the federal level. So I can't answer specific state questions other than saying, again, 38 states don't tax Social Security at all. These 12 potentially do. So that's at the state level. That's easy. We got that out of the way. At the federal level, it's actually pretty interesting. At least I think it's interesting. Again, I also think taxes as a whole are interesting. So that tells you something. No more than 85% of Social Security benefits are taxed at the federal level. Now, that doesn't mean they're taxed at a rate of 85%. It just means if you have, let's say, $100 of Social Security benefits for the year, at most 85 cents of it will be included in your taxable income. That's what that means. So no more than 85%. The interesting fun fact, so when Social Security was created in 1935, the benefits were tax-free. There was no federal income tax on Social Security benefits, and I don't think any states tax them, although I'm not sure. I'm just assuming they didn't. In the early 80s, the Social Security system was financially strapped, shall we say, and there was Alan Greenspan at the time, under the Greenspan Commission, was appointed to figure out ways to help bolster and strengthen the Social Security system. So a bunch of changes were put into place, one of which was starting to federally tax Social Security benefits. Now, what's interesting about it is, at the time, or 1984, I believe it was, no more than 50% of benefits were taxable, whereas now it's 80. So in 1984, they put in that first 50% cutoff, if you will, or 50% taxable. But even then, the intention was it was only supposed to hit the highest few percent of income people in the United States. It was basically just a tax on the not necessarily ultra wealthy, but the highest few percent of income earners. I forget the exact figure. Something like 5% of the Social Security receiving population was actually pulled into taxation at the time, 1984. Fast forward now, what are we? 35 years later. The income thresholds, which I'll show you in a second, the income thresholds that trigger when your Social Security is taxable have not increased since in 35 years. So inflation happened, income goes up, etc. More and more people now are getting sucked into having their Social Security benefits taxed. I think it's around 50% or so of people on Social Security have their benefits taxed, whereas 1984 it was like 5% or something. So this is like a stealth tax, if you will, because every year more and more people get subject to it, even though the tax itself hasn't technically gone up. I see a question here. One second. Elizabeth Boardman, I've converted money from my pre-tax retirement account to Roth. I feel a quarterly estimated tax from tax does that not have tax withheld. Can I prorate the conversion amount to pay tax due the remaining 3 quarters, or do I need to? Good question. So Elizabeth, question about quarterly estimated tax payments. Yes, so not to get too off track, but the United States tax system is a pay-as-you-go system. You're supposed to pay tax sort of as you accrue it. So if you earn $1 and you're in the 20% tax bracket, you should be paying 20 cents as you earn that dollar, and then every dollar thereafter you should have something withheld. That's why people who work at W-2 paying jobs, you have taxes withheld. They do the work for you in paying as you go. For those that are self-employed, or when you retire and you no longer have an employer to automatically withhold taxes for you, then it's on you. Now, most forms of income Pensions, annuities, Social Security, you can elect to have withholdings done before they send you your check, or you can just manually send in money yourself every quarter through the IRS website, or there's something called 1040 ES you can figure out. So the question is, if basically if you under withhold in one quarter, can you make up for it in the others? Um, Good question. Yes, yes, you definitely should. I mean, don't continue to. You don't want to hit the end of the year having an aggregate under withheld. Now, there's a few different ways, and honestly, it's quite convoluted, and I don't remember the rules right off the top of my head. But there's a few different ways you can calculate your withholding. Some of it you can sort of tick and tie it to when you actually earn income. So people who are self-employed and have very seasonal businesses have very lumpy income. You can sync it up with that, or you can just take your total tax amount and spread it even across 4 quarters, and that should suffice. So Elizabeth, I'm assuming you're probably fall into that second category. Whatever you under withheld the first quarter, just make up for it the second quarter, and then even out the last 2 quarters, and try to by the end of the year make sure you get yourself to square, and you should be okay. Good question. Mark, Colorado may also tax your Social Security payments. Yeah, I heard that. It may have actually been Elizabeth Boardman had mentioned that when I posted this a few weeks ago. So my source of these 12 states that do tax came from taxfoundation.org. It's they call themselves bipartisan tax think tank. I find them to be one of the most reliable and reputable. So that was my source for these 12 states. I noticed Colorado was not on it. I don't know why. Maybe Tax Foundation's wrong, or maybe Colorado has since changed. I don't know. But Mark is saying Colorado may also tax your payments. It's a convoluted formula to see if they're taxable. So if that's the case, then yes, if they have any sort of provision which could even potentially tax Social Security, they should be included in that list. I apologize if it was left off at Tax Foundation. So thank you, Mark. District pension. Okay, yeah. So Elizabeth just commented on that. Sounds like in Colorado, some pension income is excluded. So okay, yeah. Different states could have drastically different rules and processes for calculating tax. So I'm not surprised that Colorado or any other state for that matter could have a really convoluted and complicated formula. Okay, thank you. All right, so going back to the federal level, this is where it gets a little interesting. The amount of your Social Security that is subject to income tax is based off what's called your combined or provisional income. I haven't seen these two terms outside of Social Security taxation. Again, it's called combined or provisional. Now, what is that? So the formula is here. Again, excuse my very simple holding up piece of paper in front of camera method, but this was the easiest way I can find to share stuff. So what you do is you take half of your total Social Security benefits. Now, these are your gross benefits. These aren't what you get net of Medicare being withheld, or net of any taxes withheld, or anything else, to the extent you have some sort of, I don't know, child support or other payment taken out. This is the gross payment. So you take half of that, you add to it basically all of your other gross income. Now, it's not exactly the same as all your other gross income. I believe it excludes two things like student loan interest and another educational deduction. But otherwise, it's basically your adjusted gross income line from your tax return. And then you also add to it, this is where it gets a little quirky, non-taxable interest income. So things like municipal bonds. A lot of people like them because you do not pay federal income tax on interest from municipal bonds. You often do have to pay at the state level, but not federal level. So a lot of people, in thinking that they are doing themselves good by trying to help reduce their federal income tax bill, may load up on municipal bonds. Those are bonds issued by state and local governments or public utility companies or something. They may load up on those because the interest is tax-free. Well, guess what? That interest gets included in your combined or provisional income for purposes of determining how much of your Social Security gets taxed. So that's the formula. So again, half of your Social Security, your gross Social Security benefits, plus all your other gross income, plus the tax-exempt interest, which is basically just muni bonds. I mean, there could be some other federally tax-exempt interest, but for all intents and purposes, it's basically municipal bonds. So that's your combined, or AKA provisional income. Cool. So now that you have that in hand, what do you do with it? Now here are the actual levels of when things get taxed. So I mentioned in early 80s was when the government first built in the up to 50% of Social Security could be taxed. Later, at some point in the 90s, I think it was, they added in a second tier, up to 85% could be taxed. So that was, again, another effort to try to shore up the Social Security system. So Social Security system gets its money, gets its income from three places. One is payroll taxes that basically everyone who works or is self-employed pays into the system. Two is interest that's earned on the money that's sitting in the Social Security Trust Fund. And third is the income taxes that Social Security recipients pay on their benefits, those three sources. So, go back 35 years, the system didn't have that third source of income because benefits weren't taxable. So to help bring more money into the pot, they started adding income tax to Social Security benefits. So anyway, all right, so these are the levels of combined or provisional income that will trigger Social Security taxation. I'll try to keep this as steady as I could. There we go. So it's different if you're married filing jointly, is the bottom section, or all the other statuses. Single, most people are going to be married or single. There's something called married filing separately, which is rarely beneficial, but in a few select cases, you could be married and file separate returns. Now, the gotcha with that when it comes to Social Security taxation, even if you only earned $1 and you're well below any of these thresholds, if you file married filing separately, you need to live apart from your spouse from the entire year. If you live in the same house even one day, both of your Social Securities are automatically, or 85% of both of your Social Security is automatically taxed. The rest of these thresholds don't apply. So if you are married filing separate, you need to live apart the whole year, not even one day together, in order for these thresholds to apply. Otherwise, you're at the 85% level. So let me just look at these levels. So if you are single, for example, and your combined or provisional income is below $25,000, none of your Social Security benefits are taxable. If you're single and it's between $25,000 and $34,000, then up to 50% of your benefits are taxable. And then above $34,000, up to 85% of your benefits are taxable. And you can see the bands are a little bit, there we go. The bands are a little bigger for married filing joint folks, but not by much. And so these are the levels that have an increase. So for example, in 1984, if you were single and made below $25,000 of provisional income, none of your benefits were taxed. $25,000 isn't a lot today, but it was, relatively speaking, 34 years ago. I did the math in that YouTube video I had. I forget what it was. I think accounting for inflation between early 80s and now, all of these levels should be about 2 to 2.5 times higher, I think. So to put 1984 dollars into today's dollars, that 25,000 would be like 60-ish thousand, I believe. So if you were single, you'd have to have 60,000 of provisional income for taxation to kick in. Now didn't happen clearly. These things have not gone up in 35 years. So every year, more and more people get their benefits sucked into taxation because of this. Okay, so that's the significance of combined or provisional income. I've never seen those terms or that measure of income used anywhere outside of this slick table here to figure out how much of your Social Security benefits are going to be taxed. Cool. So that's how they're taxed. How can you minimize it? Now that's a $1 million question, right? And that's kind of, I assume, why every one of you is a member of Taxes and Retirement. Just stepping back, I mean, you'll notice this in my posts, and I'm going to say the same thing now. The best way to reduce not just how much of your Social Security benefits are taxed, but also other general income tax, or even those stealth or hidden taxes I did the video on, like the surcharges to your Medicare premiums, the potential loss of premium subsidies if you have to buy insurance, health insurance through the government marketplace. Um, the only real way to help minimize or avoid these things is to have less taxable income in retirement. Now, if there was a single answer that can solve all those problems and get you there, great. It's not that simple. It basically comes down to find ways to obviously reduce your taxable income, but how do you do that? A Roth contribution, a Roth IRA, Roth 401k is a great way. Now, I'm sure everyone's heard about those, at least to some extent. The downside is you pay tax on the money now when you put it in, but the upside is it grows tax free and the money all comes out tax free. So it's a trade off. The traditional way of thinking about it is simply if my tax rate now, or if I make more income now than I will in the future, then I'm probably paying higher tax now. So I'd most likely want to do a tax deferred account like a regular IRA or 401k, where the amount I contribute now saves me on tax bill today. And then when I take the money out 10, 20, 30, 40 years later, then I pay tax on it. Historically, people are, okay, fine. When you work, you're probably making more money than when you're going to retire. I think that's generally true, just in terms of total income in many cases. But what you don't know, taxes in retirement are my biggest concern. Yes, great observation, Shanna. I think a lot of people feel the same way. What you don't know, what the wild card is, even if your income, total dollars of income, ends up being lower when you're retired, what's to say tax rates, tax brackets themselves won't be worse, right? And it's not just the income tax brackets themselves. It's also the other taxes, like I mentioned before, things that are unique to retirees, like Social Security getting taxed, or having to pay additional premiums for Medicare based on your income. Medicare doesn't start till you're 65. So someone who's 20, 30, 40 years old and working, they probably don't even know about these additional Medicare taxes. And if they do, they don't care because it's, whatever, decades off on the road. They just want to save some tax bill today. So that's why they do traditional IRA, traditional 401k, but you're just kicking the tax can down the road. It's not a tax deduction, it's just a tax deferral when you put money in IRA, 401k. The tax man cometh, and you don't know what it's going to be. Tax rules and legislations are always subject to change. We don't know what taxes are going to be in 5 years, let alone 20, 30, 40 years, right? So it's a big gamble. We know what they are today. One thing we know for certain, objectively, is that tax rates, federal tax rates at least today, are lower than they're going to be in 2026 and forward. Under the Tax Cuts and Jobs Act, which went into effect in 2018, there was a temporary reduction in federal income tax rates. So we're in that reduction right now. All else equal, the brackets are going to go up. It's about 2% per bracket, if not more. So a dollar taxed today is 2% better than a dollar taxed in 2026 or later. So that's fact. Add to that the economic impacts of the coronavirus pandemic and the amount of stimulus money that's getting thrown everywhere. It's money just getting printed from nowhere. The world's going to have to pay for that. Taxes are going to, in my opinion, will have to go up further beyond just the normal, the Tax Cuts and Job Act expiry that's due to happen in 2026. Things are going to have to go up more, I feel at least. So that sort of supports, the argument of why would someone do a Roth contribution today where you have to pay tax today to not pay tax in the future. Even if you are still in relatively high earning years because of your job and you retire, your wages go away, or reduce significantly, yes, but you still don't. I'm convinced tax rates have to be higher. So, long way of saying one of the more common ways to help reduce your taxable income in retirement. Now, this sort of takes some planning to get ahead of it. If you're, a lot of people just plowed money into regular 401k at work or regular IRA for 40 years and saved themselves a lot of tax along the way, but then you hit 65, 70 years old, and 100% of your money is going to get taxed because it's just all plowed into this tax deferred vehicle that, boom, once you take it out, every single dollar is taxed. That's a problem you'd like to try to avoid, or at least balance out. If you can go back a few years, 5 years, 10 years, 20 years, and not just pile all your money into tax deferred stuff. Split it up. Do some tax deferred, some Roth, some in a regular brokerage account, regular after tax brokerage account that has its own um, tax benefits as well. So tax diversification could help if that makes sense. Where your money, everyone knows asset allocation, how much is stocks, how much versus bonds. There's also asset location, what type of account your money's in. Tax deferred accounts, IRAs, 401ks, 403bs, 457s, TSP. Roth, right? You pay tax when it goes in, don't pay tax when it comes out. And then regular brokerage account. You pay tax when it goes in, may or may not pay tax when it comes out. It depends what money you're taking out, whether it was a gain or it's interest or it's something. There's actually a fourth account to add to that, which has sort of the tax trifecta, HSAs, health savings accounts. Now, not everyone can get one. You need to have what's called a high deductible health plan. So you need a health insurance plan that has, I forget the limits. It's like, I want to say $16,000 deductible. I could be making that up. They change every year. I don't remember, but a high deductible health plan. So you need first a plan that qualifies. Then you can open up an HSA, which is health savings account. Now, like a tax deferred retirement account, HSAs had the benefit of you don't pay tax when the money goes in. Money grows tax free. And like a Roth, it comes out tax free. So it's triple tax benefit. No tax in, no tax along the way, no tax out. Awesome, right? But you can only get it if you have a high deductible health plan. And for most people who have health insurance through work, you don't really have a choice. Your employer offers you whatever plan you have. You'd be foolish to turn down their plan, which is often heavily subsidized, to go buy yourself a different plan just for the sake of opening an HSA. I don't think that would typically be a wise decision. But if you can get one, that's a great way to save for retirement. Now, the few caveats are you can only put in, I forget the limit. If you have a family, it's like $7,000-ish per year currently. And you can let it sit there and stay invested. You can pick investments in the HSA, so you can treat it like a regular investment account in the sense that it's not just cash that sits there and does nothing. You can pick what it's invested in. So if you're 20, 30, 40 years old, you have an HSA, you can put this money in there and let it sit there for decades. Now, the money that you take out, in order for it to be qualified and tax-free on the way out, it needs to be for a qualified medical expense. As the law is written now, you can use that money when you're 70 years old to pay for your healthcare expenses at the time. You can use it to pay Medicare premiums. You cannot use it to pay for Medigap, supplemental insurance to Medicare, but you can use your base premiums and any other sort of out-of-pocket expenses. So you can have potentially decades on your side of investment growth by using an HSA, and it's all tax-free on the way in, tax-free on the way up, tax-free on the way out. So Roth accounts, HSAs, regular brokerage accounts, basically anything that diversifies your retirement money out of just being in tax-deferred accounts like IRAs or 401ks, where you're going to get zonked in taxes when you eventually take the money out. So that's kind of the low-hanging fruit. That's the easy way, and typically my answer to most of these questions, like how do I help minimize taxes in retirement, it's to the extent you can diversify your tax location of your money. Even if you're already near or in retirement, you can still kind of rejigger and transfer around your money. You can do Roth conversions, which is taking money from your regular tax-deferred IRA, convert some or all or anywhere in between to a Roth. Now, the amount you convert, you have to pay tax on in that year. So when you do conversions, you have to be very careful to be cognizant of how much other taxable income you're going to have, how much more you're adding by doing this conversion. And there's other sort of like stealthy, tricky things to watch out. So in New Jersey, for example, we have really high property taxes. But there's something called the homestead rebate, and there's also a senior freeze, which is specific to people over 60 or 65. Long story short, they're both reductions or rebates in your property tax, and the amount you qualify for, if any, is based on your taxable income. So if you do a Roth conversion, not only will that converted amount add to your regular income tax, but it can also bump you up one of these other thresholds that can knock you out of eligibility to receive a property tax rebate in the case of New Jersey or any other states that have income-driven rebates or incentives like that. So you need to be careful in doing that. But nonetheless, point is it's an option. I work with clients where they're in retirement, they stop working, and we do Roth conversions to move money out of the tax deferred account to a Roth account. Partly to help them minimize their tax bill, but also not to get too off track, but it also helps for like estate planning purposes. So to the extent money is most likely going to be left to kids or other family members or whatever, um, when people inherit money in a Roth account, they don't have to pay tax on that money. When people inherit money in a tax deferred account, like an IRA or 401k, they will have to pay tax on that money. So doing conversions and getting money into Roths and other non-tax deferred accounts could help not just you, but also your ultimate beneficiaries. So other ways to minimize your taxable income, uh, things like using home equity. So there's some really creative planning that could be done, especially in this window between when let's assume you retire early, mid 50s, late 50s, whatever. Your wage income goes away. So all else equal, your taxable income drops a lot. You haven't yet started Social Security, so you don't have that income coming in. You're not yet 72, so you're not forced to start taking distributions out of your tax deferred accounts. That's something generically called the tax planning window. You have a lot of control over where you get your income from. If you wanted to, you can. I don't normally advocate, borrowing against your house to pay for living expenses, but there are cases where that could make sense. If you're trying to keep yourself under the Social Security tax limits here, or you're trying to keep yourself under Medicare limits if you're 65 or older, you can temporarily pull some money out of your house because any cash you pull out as a loan is not taxable to you. So that's not taxable income. It's not going to force you to pay higher income tax. It's not going to trigger off any of these other income-related thresholds that we talked about so far. It's an option. Again, it's not for everybody. I wouldn't say using debt or borrowing against your house should be your first means of generating income, but it is tax-free income nonetheless. Now, the downside is you may have to pay it back, especially if it's a traditional home equity loan or line of credit. You need to pay it back. If it's a reverse mortgage, you don't. It doesn't have to get paid back until you eventually die or your spouse, whoever's last to live in the house. Only after you're out of that house do you then have to pay the loan off. I'm not specifically recommending, again, any of this, including reverse mortgages. It's another tool in the toolbox. Some people people who sell products may try to sell that product as like the panacea that cures all ailments. That's the wrong way to go about it. Every tool, every product, every investment, every strategy has its time and has its place. You can't go around recommending it without first knowing if it's going to work or even if it's going to be of detriment to someone. So point is, it's an option. I'm not here to promote or recommend any of these things. I'm just saying these options exist. Another way to get some income, tax-free income, is if you have cash value life insurance. Now, I wouldn't, just my opinion, but I wouldn't go out and buy any sort of cash value life insurance purely as a tax play. There was a question on taxes and retirement yesterday or a couple days ago exactly about this. And my view is only buy an insurance product if you actually have a need for life insurance. The rest of the features and bells and whistles that are bolted onto it, yes, they have their value, but they sort of muddy and complicate the product. These products try to be all things to all people, and in my view, once you start doing that, you're not really good at anything. You're kind of okay at a lot of things, but not really good at anything. If you need life insurance, get insurance. If you don't, I wouldn't buy insurance products with the primary purpose of generating tax-free income or otherwise as some sort of savings vehicle. But anyway, if you do happen to have cash value life insurance and you've had it for a while, it's actually built up some cash value that you can take out or borrow from, that's another means of tax-free income in retirement that you can use to sort of bridge a gap. If you need a little more money to live on without triggering off more taxable income, you could possibly do that. I'll leave it at that. So those are kind of the main ways to reduce your taxable income. Again, long-term planning wise, taking advantage of Roth accounts or even regular taxable brokerage accounts instead of just plowing all money into a 401k or traditional tax-deferred IRA. Once you're in retirement, potentially home equity, potentially cash value life insurance. Social Security, it's frankly going to be hard to stay under these thresholds. 20, 30 years ago, it was fairly, I don't want to say easy, but you had a much better chance of, if you're single, staying under $25,000 in provisional income. Now in 2020, that's going to be hard. So I don't want to say the ship has sailed for trying to really keep yourself under these thresholds. It's still possible, especially if you're in that tax planning window where you stop working, you haven't started Social Security, there's really no other income coming in, you choose where it comes from, then yeah, maybe you can keep yourself low enough. This has nothing to do with your assets. You can have $5 million of assets. This is purely income based, right? So if you have assets that you can creatively tap on a tax-free basis to get yourself some living expenses while staying under these, sure, I guess you can stay under these thresholds. But frankly, it's going to be hard because these are small and they haven't gone up in decades. But if you can, great. And it's definitely something I try to do when I work with people. To the extent possible to reasonably stay under these, of course, we'll try to do it, but it could be difficult, frankly. And for those of you that are interested in how this actually shows up, I have a sample tax return. It's all fake information, so I'm not giving up anyone's social here. If you look at this line here, it says Social Security benefits. It'll show the gross amount. That's the total you actually get before Medicare deductions or tax deductions. And then over here, so in this example, it's $20,000. And then over here, only 17 of it is actually taxable. That's 85% based on this example I threw in. But anyway, for those of you that actually look at your tax returns, this is where you'll see it. Like that's a total you actually get. Here's what's actually taxable, only 17,000 in this example. Okay. Finally, I just wanted to say why Social Security is one of the more tax advantaged forms of income you can have. So right off the bat, it's not taxed at the state level in most states. Again, 38 don't, 12 may, well, possibly 13. Colorado is TBD, but looks like it does. So there's no state tax on it in most cases. At the federal level, as you can see, at most 85% of it's taxable. So that right there, dollar for dollar, is better than you drawing a dollar out of your 401 or IRA, which is going to be taxable, period. Social Security at most is 85% taxable. And this is another sort of longer term planning strategy. Again, going back to that tax window. So let's say you retire at 60, your wages went away, your income's low. You're not yet 62, so it's not possible to have started Social Security. Unless you're a survivor, you can start at 60, but otherwise 62 is the earliest. And then you're not 72, so you're not forced yet to take out what's called required minimum distributions from your tax deferred accounts like IRAs and 401ks. I'm a fan of Social Security. Now, this is a personal decision. I'm also a moderator in another group, a Social Security-based group, where this topic is hotly debated. Do I claim early? Do I delay as long as possible? And anywhere in between. There's lots of guessing that goes into it. Honestly, a lot of it comes down to your longevity and when you expect you're going to die. It's a morbid thought, but that plays into it. If you're married, there's consideration you have to give to your spouse because Social Security pays survivor benefits. So you may actually want to maximize and delay your benefit to not just benefit you while you're alive, but your spouse if you die first. But point is, you can do tax planning and Social Security maximization as sort of one package. So when you're in this tax planning window, you don't have much, if any, taxable income. Where's your money going to come from? If you want to delay Social Security, you can start drawing down and living off of your tax deferred income. If you have no other taxable income, you can fill up your lower tax buckets of 12%, 22%, etc. by taking out of your 401 or IRA to meet your living expenses, and you're only filling up those lower tax buckets. Meanwhile, you're letting your Social Security sit and grow. The longer it sits untouched, the longer it grows until age 70, which is, maxes out its growth. So that by the time you hit 70, let's say, if you delayed Social Security the whole time, not only will your Social Security benefit be higher than it would have been had you taken it earlier, so that means more money for you to live off of when you do start it, but you've also spent down some of your tax deferred money. So when required minimum distributions do kick in, there'll be less of that that's going to get thrown at you or you have to take out, which means less taxable income. So by doing that, it's a little complicated, but you basically shifted your source of income. Had you taken Social Security early, it'd be relatively small, and so a lot of your living income would have to come from drawing down your IRA, your 401k in your later years. By front loading that and doing that drawdown early, you're paying tax on your terms. You're taking that and realizing that income on your terms during this tax planning window while delaying Social Security. When you do start Social Security, again, at most that's 85% taxed, whereas 100% of your IRA or 401k is taxed. So right there, you save a little bit. Plus now you maximize your Social Security benefit, so it's larger. The other benefit to Social Security is it goes up with inflation every year. It's fixed, it's guaranteed. Now, I should say guaranteed, with an asterisk next to it, because who knows what's going to happen, whether the benefits decrease or not. They are expected to, before the coronavirus pandemic, the trust fund was expected to deplete in 2035. I did a video on that if you're interested. For what it's worth, my opinion, I don't think people who are currently taking Social Security or are close to it are at risk of having their benefit reduced, but people who are under, I'm just going to put a number out there, let's say 50 and below, I have to think that benefits are going to go down for them, and we'll have to pay more in. But that aside, otherwise Social Security is quote unquote guaranteed for life. So, it won't go away. Will go up every year with inflation, and it's taxed lower than withdrawing money from IRAs and 401ks. That's why I like it, and not taxed at all at the state level for most states, 38 states or 37 states, whatever the right number is. Plus, it pays survivor benefits if you're married. You can't give it to an heir, but if you are married, when you die, your spouse gets whoever's payment was higher, whether it was which one of you, that higher payment lives on when the first spouse dies. To the extent you have minor children or disabled children, they can also potentially get benefits off you, not just while you're alive, but also when you die. There could be survivor benefits for minor or disabled children as well. So anyway, a lot of value to Social Security, pretty tax favorable for a few reasons. So one thing to consider when making your decision of when should I claim Social Security. All right, that's all I had. Hold on, let's see if I have a question here. Yes, Shannon Clay. I'm retiring at age 60 and spending down traditional, thinking of delaying Social Security until 70 to avoid. Perfect. Yes, that's exactly what I was saying. Now, the difficulty with tax planning, and even all the questions that come in taxes and retirement, which are fantastic questions. I'm really thankful and appreciative of the great questions that come in. These are all questions getting answered on kind of a one-off basis. Answering a question about Social Security tax, answering a question about Roth conversion tax here, answering a question about closing out or taking money out of a cash value life insurance here. Every single one of these things all interact with each other. You can't decide or make a decision on any one of these things in isolation, which is what makes this whole process difficult. To further compound that is with taxes, again, no one knows what tax legislation is going to be in 5 years, 10 years, 20 years. The best we can do is kind of go off what we know today and rational thinking of what we think may happen. It's really reasonable to think taxes are going to have to go up in the future given, again, current environment and all the money that's getting created from nowhere due to all the stimulus money. So, right. So what I'm saying here, this isn't actionable advice. I'm not saying everybody go spend down your 401k to go maximize your Social Security. All these things are going to be facts and circumstances based. There's a lot more to your financial picture than just what I know about or what you ask in these questions here. So don't take what I'm saying as like, yes, go do this. Unless we have a working relationship where I am actually advising you and know your whole profile. This stuff's not advice. This is education and helpful hints. Please leave it at that. I'm happy to answer as many questions as possible, but this isn't specific actionable advice to any one of you on the taxes group or these live chats. Mike Henderson, what is the Social Security group you moderate? Yes, so it's called Social Security Intelligence Members Group, I believe. It's not my group. It's there's a fellow in Texas, Devin Carroll. Social Security is his thing. He's written books on it. He's got a really well built out YouTube channel on it. He's got a blog about it called Social Security Intelligence. And then he has his Facebook group, Social Security Intelligence Members Group, which is like my taxes group basically, but his is all just Social Security. So definitely feel free to join that. It's very active group. It's like 7,000 plus people at this point, maybe eight, probably a dozen posts a day. I am one of a handful of the moderators on it, so I frequently chime in on questions and comments. What do we got here? Art. Yes, Art. Keep in mind that the standard deduction will go down before you hit 70. I'm on a 15-second delay, by the way. I played around with this before to see how this worked, and it looked to be a 15-second delay. So if I'm reading your comments slightly delayed, I apologize. So Art, I see you're saying, Shanna, keep in mind that the standard deduction will go down before you hit 70. Art, do you just mean because that when the Tax Cuts and Jobs Act revert, the standard deduction to drop back to pre-2018 levels? I'll assume so, but if you mean otherwise, please let us know. Julia, if my husband started to take Social Security at full retirement age, can he pay it back and wait till he's 70? Sort of. I'm not 100% sure what you're asking, but there's two possible answers, I think. This applies to anybody. When you start taking Social Security, there is a do-over button that anyone can use within the first 12 months of starting your benefits, whether you start at 62 or you start at 67 or 68, doesn't matter. You can say, oops, I don't want to do it. So for example, let's say you plan on starting Social Security at 65, but you get laid off at 62. Your knee-jerk reaction is, I need income, let me start Social Security. Boom, so you do it at 62. 6 months later, guess what? A new job comes across and out of nowhere, and you take it. Now you don't need that Social Security money. What do? You can completely undo it. Again, you can only do it once in your lifetime. You can do it within 12 months of starting. You can say, hey, I don't want to do it. Take it back. The downside is you need to pay back every cent you received while you were getting benefits. Not just the benefits you got, but any spouses or children who also got benefits off your record. Those all need to get paid back. It's truly as if it never happened. You didn't claim to start with. So that's one option. The second option is if you're older than your full retirement age, you can suspend your benefits. When you suspend, you don't pay anything back. You stop receiving it. You temporarily freeze it. You can continue receiving the delayed retirement credits to let your benefit grow while you're suspended, and then you can turn it back on at a later point. So if your husband is full retirement age, he has either of those two options. He can hit the undo button if it's within 12 months of when he first started, or he can just simply suspend it, not have to pay anything back, and then restart later at age 70. Hope that answers your question. Cody Garrett, can you discuss how far you should or should not stretch lifestyle and income to minimize taxes? It's something difficult to not let the tax tail wag the dog. That's one of my cheesiest but most favorite sayings. Don't let the tail wag the dog. Right. This is going to part personal decision. So I stealing this comment from Rick Edelman, I think personal finance is more personal than it is finance. I firmly believe that. As you can tell, I'm kind of more technical, a little professorial. I might be more the finance and the personal side, but I do fully realize and acknowledge there's a lot of personal preference and opinion and emotion that goes into all this stuff, and I try to be, aware and take all that into consideration. So Cody's question is, how far do you, or maybe how tight do you make yourself live, all in the name of minimizing taxes? To me, it's a trade-off, honestly. You just like the FIRE movement, which is financially independent, retire early. These are people who live so rock bottom, cheap and bare bones, so they can retire at 40 or something like that. Like, is it worth it? I don't know, how much you sacrifice in those 20 years of working and living as an adult just so you can stop working. That answer is going to be different for everyone. So it's tough to say. There's no necessarily right or universal answer in any of this. I mean, there's clearly bad decisions. I don't know, investing your entire life savings into one single stock is a bad decision, for example. And there's good decisions. There's not necessarily the right decision. It's all going to be trade-offs. It's all a bunch of little levers. You pull this, this one goes down, this one goes up, this one goes down. You kind of have to weigh all these pros and cons. And again, layer in, no one knows what taxes are going to be down the road. So a lot of the value, frankly, in tax planning is to have diversification and options. Whether you're 20 now or you're 60 or 70 now, a lot can change in 5 or 10 years tax-wise. So you want options. The more optionality you have of where your money is, meaning tax-deferred accounts, Roth accounts, regular brokerage accounts, that can give you the tools to better manage your sources of income and sources of tax whenever you start pulling from the money. So I don't want to say it's a leap of faith tax planning, but some of it is. Some of it's just let's hedge ourselves. Let's diversify our potential tax liability as best we can now to help us out in the future. And another cheesy but good analogy I like with financial planning and tax planning is think of every decision you make like a seesaw, right? Teeter-totter, whatever you want to call it. On one side is the current you, the present day you. The other side is the future you. Everything you do to benefit the current you, or should I be going the other way? Whatever. Everything you do to benefit the current you, in a sense, takes away from the future you, and vice versa. And that sort of gets to the heart of your question. Like how much do you sacrifice and skimp now to hopefully save yourself a few percent in taxes in the future? I can do some of the number crunching and estimates and projections, but a lot of it's going to be sort of personal opinion. How much do you want to sacrifice now versus delayed gratification versus not? Not sure. So not a great answer, Cody. I apologize, but honestly, that's the frank answer. Anyone that tries to say this to give you a factual answer to this is fooling themselves. It's going to be a lot of subjectivity and what ifs and personal preference that goes into it. Julia, then you can take out money from 401k. Yes, talking about the duo. Okay, yep. Julia, Dan, good. Julia, you are giving us good ideas. Well, thank you. That's what I'm trying to do. I'm glad at least some of you are finding this useful. Great. Okay, that's all I have. Hopefully you enjoyed this. I will try to be sure to be appreciative and careful of your time. I said we'd stop at 9. We are 7 minutes short. Hope you enjoyed. If anyone else has any questions, please feel free to pop up. It's a great. Okay, good. Thank you, Cody. All right, so I'm going to wrap this up. I will be posting in the group about next. I liked this. I think this went okay. Good questions. Thank you. I appreciate the activity here. I'm probably going to do this every other week for now. We'll see how that goes. So expect another post. I'm not sure what next week's topic or 2 weeks topic will be, but expect more of these. So thank you all. Hope you enjoyed, and it was as fun as it can be talking about taxes and retirement. So thanks. Enjoy the rest of your night. Take care.